Your dividend check is a lie. The $2 million mistake Wall Street doesn't want you to understand. Picture this. You're 72 years old, sitting in a leather chair, staring at a brokerage statement that just deposited $400 into your account. You feel proud. You feel safe. You feel like you finally beat the system. But you didn't. What actually happened is your own money walked out one door and came back through another, and a tax collector took a bite on the way. You just celebrated losing money and called it income. That's not a metaphor. That's arithmetic. And if you've spent years building your entire retirement plan around this illusion, what I'm about to tell you might be the most uncomfortable 10 minutes you spend on YouTube this year. There's a fantasy that owns the retail investing world right now. Millions of people believe that if they buy the right stocks and never sell a single share, money will simply appear every quarter like rent from a tenant who never calls. They imagine a beach, a hammock, a check clearing while they sleep. It feels like magic. It feels earned. And it is almost entirely an illusion built on a trick of human psychology, not on financial reality. Here's the mechanism nobody explains clearly. Imagine you own a business outright, cash and all, worth exactly $1 million. You decide to pay yourself $100,000 from the company account. You now hold six figures in your hand, and your business is worth $900,000. Your total wealth hasn't moved an inch. You just relabeled the jar. This is precisely what a public company does on what's called the ex-dividend date. A $100 stock paying a $2 dividend does not open the next morning at $100. It opens at 98. The exchange marks it down automatically because the company is now, quite literally, $2 poorer per share. You didn't get richer. You performed a withdrawal from an ATM and mistook it for a paycheck. This isn't some fringe theory. It's the foundation of a Nobel Prize-winning idea from economists Merton Miller and Franco Modigliani, and it says something that should unsettle every dividend-chasing investor watching this. In a rational market, paying a dividend does not create one additional cent of wealth. None. It only changes which pocket your money sits in. So why does this fantasy have such a grip on us? Because our brains evolved mental shortcuts for a world without spreadsheets. We instinctively separate capital from income, the goose from the egg, and we've been trained to believe selling shares is reckless while collecting a dividend is virtuous. But in an age of zero-commission trades and fractional shares, there is no meaningful difference between a company handing you 4% of your value as a dividend and you simply selling 4% of your own shares yourself. Same cash in your pocket, same reduction in your holdings. The only difference is a feeling, and feelings don't compound interest. Here's where it gets worse. When a corporation decides for you that you're receiving cash, you lose control of a decision that should be yours alone. In a taxable account, that dividend triggers a tax bill immediately, whether you wanted the money or not, whether it's a good year for your income bracket or the worst one of your life. Compare that to selling shares on your own terms, where you choose the timing, choose which lots to sell for the lowest tax hit, and choose to do absolutely nothing in years you don't need cash, letting your capital compound untouched. This is called a homemade dividend, and it is not a workaround. It's simply smarter. You're volunteering for a worse tax outcome every single time you chase yield instead of building it yourself. Now, for the revelation that really stings. A dividend is not always a badge of strength. Sometimes it's a confession. When Apple and Microsoft were exploding in growth, they paid nothing to shareholders because management believed every dollar kept inside the company would multiply into 5. They were choosing to respect your capital by refusing to hand it back. When a company instead starts writing you fat checks, it's often quietly admitting, we've run out of ideas. No new factories, no breakthrough products, nothing better to do with this cash than mail it to you. That's not always a red flag. Mature, stable businesses can pay dividends responsibly, but chasing the highest yields available in the market is frequently how investors wander straight into melting ice cubes. Tobacco companies dying telecoms, businesses slowly liquidating themselves while calling it generosity. And this is the part that should genuinely alarm you. Yield and total return are not the same number, and confusing them is how fortunes quietly evaporate. If a stock pays a 10% dividend while its share price bleeds 5% a year because the underlying business is decaying, your real return is 5%. If another stock pays nothing but compounds 10% a year through reinvestment, it wins decisively every single time. You cannot retire on yield. You retire on total equity. Sell 4% of a growing $1 million portfolio, and your principal still climbs. Collect 10% yield from a shrinking one, and you're watching your own foundation erode while you applaud the checks. Now consider the most inconvenient witness of all, Warren Buffett. He happily collects dividends from Coca-Cola because Berkshire Hathaway pays a lower corporate tax rate on that income than you ever will. But look at Berkshire itself, one of the most cash-rich companies in human history, and you'll find it has never once paid a dividend to its own shareholders. Why? Because Buffett knows exactly what we've just walked through. Every dollar he distributes is a dollar that stops compounding and starts getting taxed. He believes he can grow that capital faster inside the machine than you could outside it, and history has proven him right over and over. If you trust the man's words enough to quote him at dinner parties, why don't you trust his actions enough to copy them? So here is the uncomfortable exit from the illusion. Stop treating a dividend like a paycheck you earned and start treating it like a forced, involuntary sale you never asked for. Stop filtering stock screeners for the highest yield and start asking which businesses compound the fastest, dividend or not. If you need income, build it yourself. Sell shares on your schedule at your tax rate from a portfolio of the best businesses on earth, regardless of whether they mail you a check. That is control. That is efficiency. That is the difference between eating crumbs off the table and actually growing the pie. The dividend fantasy sells comfort. The math sells wealth. You can only choose one. So choose deliberately, because the version of you at 72, staring at that brokerage statement, is going to live with whichever answer you pick today.